Upstart stock just took a massive hit, dropping nearly 12% in after-hours trading after its Q2 2025 earnings report. And here's the twist. They actually beat revenue expectations and returned to profitability. So why is Wall Street selling hard? Let's dig in. What happened? In Q2, Upstart reported $257 million in revenue, up 102% year over year. They posted a GAAP net income of $5.6 million, compared to a loss last year. On paper, those numbers look great. But the market didn't care. Right after the earnings release, the stock tanked, falling as much as 16% intraday, heading toward its 52-week lows near $69. The reason? Investors are worried about Upstart's exposure to loan defaults in a tightening credit environment. With interest rates still high and macroeconomic risks in play, the fear is that even strong lending platforms will feel the pain if the economy slows further. The business model. So what does Upstart actually do? They run an AI-powered lending platform that works with banks and credit unions to issue consumer loans. Their secret sauce: a machine learning model that uses over 1,600 non-traditional data points, things like education, employment history, and more, to assess creditworthiness. This tech allows for 17% more loan approvals compared to traditional credit models, lower default rates than many banks, and super fast decisions. About 79% of loans are fully automated in minutes. Upstart earns money through fees on loan originations and by sharing interest income with its 40-plus bank partners. The pros. Here, what's working in Upstart's favor. White Heavy Checkmark, their AI model, is proven to approve more loans with fewer defaults. White Heavy Checkmark, the lending process is faster and smoother than most banks. White Heavy Checkmark partnerships keep expanding, boosting reach. White Heavy Checkmark triple-digit revenue growth and profitability are back on the table. White Heavy Checkmark, they're disrupting traditional lending, making credit more accessible. The cons and risks. But there's a flip side. Warning: the stock is extremely volatile. Earnings days can swing at double digits. Warning: if the economy weakens, loan defaults could rise. Warning: valuation is sky high. The PE ratio is over 1,000. Warning: scaling while keeping credit risk low is a constant challenge. Warning: they're still dependent on banks buying into AI-driven lending and navigating potential regulatory hurdles. Short-term versus long-term outlook. In the short term, volatility is the name of the game. Key technical levels to watch are $73 and $65. If $65 breaks, we could see more downside. In the long term, if Upstart manages to keep default rates low, expand partnerships, and survive any credit market stress, the upside could be huge. But the road will be bumpy. Investor take. Upstart is high risk, high reward. If you're risk averse, this probably isn't the stock for you. If you're speculative and believe in the future of AI lending, you might consider a very small position, money you're willing to lose. Bottom line, this is not a steady grower. It's a fast-moving, sentiment-driven stock that demands close monitoring. So, did the market overreact to Upstart's earnings, or are the credit risk fears real? Drop your thoughts in the comments. And if you found this breakdown useful, hit like, subscribe, and turn on notifications so you don't miss the next deep dive.